So thanks very much for everybody who's tuning in. This week is the normal format. Basically, we're going to run through the news, and then we're going to have a chat with Robin Parbrook, who's the manager of Schroder Asia Total Return. As normal, as we go through, if you want to ask questions, just stick them into the Q&A function. Alternatively, you can just email me at jc@martinco.com. So without further ado, this is the list of things that we want to have a look at this morning. So three stocks on there: GCP Asset-Backed Income, Schroder UK Public Private, and Apax Global Alpha. The latter two have got a sort of similar theme. Starting with GCP Asset-Backed Income, this has been quite a sort of straightforward direct lending business. Obviously, it takes security for the loans that it makes. The NAV, as you can see there, is just ticked up gently since launch, and on top of that, there's quite a few funds trading on fairly chunky discounts too. So GCP trading at a premium there is actually been one of the ones that people, investors, seem to be liking. The news doesn't seem to have hit its rating yet, and we'll just have to watch and wait and see what happens, but it's possible that it might do. Here's the returns, and again, you can see, so some of these funds have made decent NAV returns over the past year. All that is a rebound of the provisions that they made a year ago. So the better indication is looking at 3 and 5 year numbers. And as you can see there, GCP is okay, but not spectacular relative to some of these ones. Now, the thing that seems to have gone wrong, as far as I can work out, is this outfit called The Collective. And they are providers of co-living spaces, which is essentially a format for residential accommodation where some of the community facilities are shared. So you might have big shared gyms and concierge and all those sort of things that we've got down there at the bottom, centralized room cleaning, that sort of stuff. So it's like service apartment type accommodation. And they've been building up a portfolio of those. I think it was founded in 2010. Unfortunately, it's now run into trouble, and I suppose maybe the pandemic has something to do with that. Gabi is a minority lender, part of a syndicate, and the loan is called Co-Living 3. And it's secured because all their loans are secured against some 10 operational assets, 5 assets of construction, one of which is 12 sites of big development, one of which is shown there on the left, which is a block they plan to build, 555 Broadway, Williamsburg in New York. Given that the thing was sort of running into trouble, they tried to sort of sell off some of the company, and they got some bids for it, but that didn't last, unfortunately. So here we are, 20th of April, when everything seemed to be okay, and they were making good noises about it. And crucially there, that the loan to value of less than 65%. So actually implies that there ought to be fairly good asset cover on these funds, so they should get a fairly good recovery on the loans. And it was the third largest investment at the end of June. On the 15th of July, though, they reduced that valuation. So effectively, the way that they do that is they reduce the discount rate used to value the loan. So it's all valued on a discounted cash flow basis. And by hiking up the discount rate, that pulls down the value of the loan in the portfolio. On 13th of September, they said that things had deteriorated, and so they made a hit to the NAV of 3.7p, which is fairly chunky if you remember in the context of what's been going on in the history of the fund. They're gradually edging up. It's taking off a lot of the NAV accrual that it's made since launch. And then on 13th September, some of the entities within that group were placed in administration. So Co-Living Group is GCP's term for the loan. As I've explained on our website, that confused me no end because there is a company called Co-Living Group, but it's not that. The rationale, what they're going to do with this is try and buy some of the assets out of the business. So the lenders have put together an acquisition vehicle to bid for 6 of the assets, 3 of which are operational and 3 of which are in development. And they will also then try and unlock the value for the remaining assets of the co-living group. So at the moment, those assets, the remaining assets, are valued at 0 in the NAV, and that's part of what the effect of reducing the NAV by 3.7p was. So if they can recover some value for that, that will unlock that and let the NAV rise back up again. So we'll just have to wait and see what happens. But I think we should give them the benefit of the doubt. Some investors are at the moment, but I think that's going to be okay. Schroder UK Public Private. Here, you know the story very well. It used to be with patient capital. Since Schroder's taken it on, it's starting to have something in recovery. We've now got the NAV moving in the right direction, which is all good. And the discount has been closing a bit, but still has a little bit to go. The discount's about to spike up though, because the NAV should soar. We'd have to see what happens to the share price, but I think it should go up. Their largest investment is a thing called Oxford Nanopore, and it's now launched an IPO. So it's looking to raise 300 million, and it's already got 150 million guaranteed from Oracle. So the rumours are that the whole thing will be valued at about £4 billion, but the actual value of it will be determined by book build. The fund owns 3.7% of the company, so the implied value of that 4 billion would be 148 million. But the value in the NAV at the moment is 90.7, and that 90.7 represents 21.8% of the company. It's by far the largest investment. It's far too big, really. And so the problem that we had with patient capital. So the implied NAV uplift could be as much as 14%. In fact, it may even be higher than that. We'll have to wait and see. Schroder UK have already said that they're going to take some of the money out. So they're going to actually sell down their stake in the IPO. And that's great news because it will allow the manager to make more of its own investments and actually sort of, I think it's the sort of final chapter in the rehabilitation of this company, actually. This could be very good news. But we'll wait and see what happens next. The other one that I wanted to mention was Apax. And here you can see this has been performing very well. The NAV has just been rising steadily, particularly strongly over the past year. The share price has been rising strongly too, but unfortunately it's still trading at a discount. And I think that discount is completely unjustified, and we'll explain why in a second. So its largest investment is a thing called ThoughtWorks, and that has IPO'd. So the IPO was priced at $21 a share, and the share price last night was $31.46. It was already Apax Global Alpha's largest underlying holding, held through their Apax 9 fund. And in June, that was valued at 76 million euros. They took 15 million euros cash out of the IPO by the time of the IPO, but their remaining stock now is worth 170 million, more or less. So that implies there's an uplift to the NAV of about 94 million euros. But that's not all, and that's the crucial thing. This is why I think this discount is just daft. At the end of June, the Apax NAV, as it says there, was €2.81, which is about 241p. But there's been a number of events since then within the portfolio. So even if we just ignore what's happened to markets since the 30th of June, and that will have an impact too on the valuation of the unlisted stuff. But this is just looking at what's going with the listed stuff. There's a whole bunch of uplifts there. There's only one that's gone down, which is a thing called Innovage. And altogether, we think that means that the NAV is something closer to €3.05, which is 260p. And that compares to a share price of 217. So it implies a 16.5% discount, which, as I said before, is way too wide. Now, I know that there's a question here. Let's have a look. What's a book build? Now, so just going back to how we were determining the price for Oxford Nanopore. So basically, investors will bid the price that they're prepared to pay for the company, and then there's a fixed number of shares to sell. So there sort of be like a clearing price. So it's like an auction, really, and that will whatever the price that they allows all shares to be sold with the price that the thing lists at. So that's a book build. Hope that helps. And Apax does pay a dividend, if that's the question. Yes. Cool. So that's enough of me. Let's now talk to Robin. Let's have